Good morning. Welcome to Fix It Finance. I'm just gonna set things up real quick so we can get her started. Oh, it's been a week and a half. How have you guys been? Hope you guys have had a good week. I know I certainly have. Um, hmm. uh, can you see me live on Instagram? I'm just trying to get Instagram going. I think I'm having issues with Instagram, but if you can see me live on YouTube, can you just drop a comment? This morning is special. We are having technical difficulties, mostly because we have no slept. I had an amazing week this week. My brother graduated, and I was feeling like the big sister of the day. And congratulations again, baby brother. You know yourself. Um, I wanted to share that with you guys just so you know. And of course, we had to go to a different city, and yeah, it's been a day and a half. So today we're gonna have a bit of a casual Saturday. Today we're just not casual in that we're discussing, some trending topics today. We are discussing the interest rate cuts. You know what that means. Remember to like, share, and subscribe. If you're new here, we go live every Saturday at 10 o'clock. And I don't think Instagram is still working. So, this is what happens when you're your uh, excuse me. Mm, okay, I see what I did wrong. Okay, sorry, bear with me. And then we will kick it off. Okay. Um, Yay, we got it working. Awesome. Okay, we're live on Instagram now. That's good. Okay. Awesome. Awesome. I just heard myself say it. Okay. Welcome to Fix It Finance. Today is Saturday, June the 6th. Oh, sorry, June the 8th. Wow, that's how you know it's been a week and a half. um, we are discussing interest rate cuts today. Um, and let's get right into it, just because we are, of course, speeding right into our time. So, welcome to Fix It Finance. I hope you take control of your money as usual, and help you build the life you want. My name is Fikayo. I go live every Saturday at 10. No, not 10. At 12 p.m. Eastern. And if you have questions, comments, or the like, we take questions live. We also take questions after the fact. Just post a comment, and I'd be more than happy to answer any question you may have. Remember to like, share, and subscribe. Make sure you send this video to a friend, and to a friend's friend. And if you're new here, again, we go live every Saturday, so please feel free to join us. And let's get right into it. Okay, so the Bank of Canada announced that they have cut interest rates, by 0.25 basis points. What does that mean? So basically, the key interest rate used to be 4.75%, and as of today, well, as of June 1st, is now at 4.5%, so 4.5%. So basically, it has gone down 0.25 basis points. So what that basically means is, you know, banks are going to adjust their own borrowing rates as well to reflect that lower interest rate. So as you know, when COVID happened, interest rates started to interest rates first of all went down ridiculously, and then of course they started to climb back up as the government was trying to combat and battle inflation overall. So there are a few economic factors. Today we're going to talk about, what does the lower interest rate mean for you, for the economy in general, and why you need to pay attention to one or two things to ensure that you don't to ensure that you set yourself up for success, rather than the opposite in an economy such as the one we have. Okay. So one of the biggest things on a lot of people's minds when you hear that the interest rates have gone down is how low would it go? First of all, let me just address the people that are thinking home prices are going to go down. Delete that fantasy from your head. It's not going to happen. Okay, never say never. It could happen. But the way, again, because who knew a pandemic could happen and the entire world was shut down the way it did? Nobody, if someone had said that would happen before, we would have said never, you know. So what I would say is a lot of economic factors are pointing to the fact that home prices are likely not going to go down anytime soon. So if you are holding your breath, or if you are waiting, if you are ready to buy, right? Keyword ready to buy, and you're waiting for home prices to go down, I really, 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 really think you're wasting your time, because I do not see them coming down anytime soon. Again, the interest rates going down is affecting, if when we talked about budget 2024, if you go back to one of our prior videos, we talked about budget 2024. In that video, we mentioned how, the government keeps working on the other side. So there are two sides to the housing equation: there's the supply side and the demand side. The demand side keeps getting a lot of action. Interest rates going down is affecting the demand side again. For every house in Canada that goes on sale, there are at least 3 people ready to buy it. Okay. 3 people that were qualified and ready to buy it. Now interest rates have gone down 0.25 basis points. That number could increase to 4. So again, when it comes to basic economics, prices are affected by supply and demand. And in our case, when it comes to Canada, there are so many factors that are affecting demand, and not enough factors affecting supply. So you have things like immigration affecting demand. You have things like all that money the government printed. A lot of people ended up saving a lot of money, while some people lost a lot of money. But at least the point of the matter is, a lot of people could now afford houses when interest rates were really low, so they bought houses. Okay, so again, the demand side of things is super strong, the supply not so much. So for that reason, or for those reasons, I don't anticipate house prices going down, but never say never. Okay, so like I was saying, the big question is, how low would interest rates go? Are we gonna see, the 1 points, the 2 points, and whatnot that we saw during COVID times, or even pre-COVID? Because the interest rates were low for a very long time, even before COVID. They went down further during COVID. Because for example, we bought our home before COVID officially hit, and we were still at 2 point something percent. Okay, so how low do we think it's going to go? Based on my, just based on what I've been reading, videos I've been watching, and just tracking the Bank of Canada, and the government, and exactly what they're trying to do, especially with next year being an election year. I really don't anticipate it going down back to the 1 points or the 2 points. I think we're going to sit around that 3.5% range. Again, because the government is also going to try and make sure they don't stimulate over consumption either. You understand? Because when interest rates drop super low, then people just start borrowing and doing whatever they want. Okay, so they're going to try and balance it out real quick. Because definitely the country can't afford that, hyper borrowing again for now. You never know, things could change overnight, but for now, that's just where we are. Okay, so like I mentioned, I personally believe Canada's home prices are going to continue staying up, and they're going to stay that way for a few reasons. Another reason why I think they're going to stay up is, in the video when we talked about budget 2024, one of the things I was ranting about and complaining about was how much debt Canada is in. So if you look at Canada as a person, so I have a link to a video that we talked about, where we talked about mortgages and credit worthiness. We talked about credit worthiness, and we said, okay, you as a person, what does the bank look at to analyze you as a person to see if you're credit worthy? So if we look at Canada as a person and her credit worthiness, okay, she has a lot of debt, like several. It's ridiculous. She has a lot of debt. Okay, so she needs assets to be able to offset those debts, quote unquote. Now homes are assets. Okay, so you have assets on this side, being the homes that people purchase and the values that those homes are worth, right? And you have the debts that Canada has on this side. So again, this is just another reason why, based on just other economic factors, house prices have to stay high, you understand, so that Canada still looks like a well balanced, you understand, a person, because she has all this debt on this side, but she also has all these assets on this side. But I won't go deep dive into that rabbit hole just because. But that's just to give you a bit of a picture. You understand? When I'm saying house prices are not necessarily going to come down anytime soon, there's so many factors that go into it. Okay, so I don't know. I think I was having this conversation with someone recently. Just don't hold your breath that house prices will come down. If you have what it means, if you have the means to buy, go ahead and do what you need to do. So, as a refresh, one of the things we talk about here in Fix It Finance is, what do you need to buy a home? Okay, the very first thing you need is to, as much as possible, pay off all high interest debt. or significantly reduce it, okay? Because this puts less pressure on your cash flow. For example, if you have a take-home pay of 5,000, you already have payments worth 2,005. You've not even bought a home yet. That's too much pressure, because once you add a home onto that, the example I always use is like back home in Nigeria, we have something called generators. They have them here too. If you have a generator that can only produce a certain amount of kilowatts, okay, once you plug in an iron, for example, you will see that the generator, it kind of shakes a little, but it's able to take on the weight of that iron. But if you go and plug in a freezer or a fridge, for example, chances are that generator is going to shake too much and then go off. You understand? So basically, it's the same thing when it comes to your take home pay. You understand? You don't want too much pressure on your take home pay, because what's going to happen is it's just going to be too much pressure. It's not going to be able to handle the pressure of having a mortgage as well as all these other payments on the side: student loan, credit card, line of credit, HELOC, this, that, and the other thing. So as much as possible, you want to pay down all those debts so you have enough free cash flow. You have enough free cash flow, not just to afford your mortgage payments, but to afford the fluctuations in the economy. For example, one of the things that a lot of people are not paying attention to is the fact that our unemployment rate has been going up every quarter in Canada. So more people are losing their jobs each and every day. Now, this is not to scare anybody. Last I checked, it was around 6.5. Unemployment rate is around 6.5%. And it's not even because more jobs are not being added to the market. More jobs are being added to the market, but it's because our population is growing too fast. Okay. So let's say 20,000 jobs are created this month. We bring in 45,000 people. All those 45,000 people are unemployed. You understand? To a large extent. So those are some of the things you want to think about. Why I say you need to pay off all high interest debt or significantly reduce it is because by the time you go into owning a home, you never know what can happen. Your furnace goes out, you need to replace your roof. Something happens, God forbid, one of you lose your job, or one partner in the equation loses your job, or you don't even need to lose your job. You go on maternity leave. I've mentioned this in a few videos. I'm currently on maternity leave, and our take-home pay has, felt it, for lack of a better word. So you need to understand there are different factors or different things that could happen as you continue your life. For example, I could decide I want to become a stay-at-home mom for the rest of my life, and that means half of our income is now significantly reduced, So those are some of the factors you need to consider when it comes to your free cash flow. You want to have as much free cash flow as possible. Even when it comes to analyzing a company, like if you want to buy a stock of a company, one of the things you always analyze is the company's free cash flow. How much cash are they producing that's free cash? You understand? Not cash. We talked about that also in a previous video when it comes to analyzing and understanding your free cash flow. So make sure you catch up on some of the episodes we've done before. Okay. The next thing you want to do if you're ready to buy a home after paying off all high interest debt, or at least significantly reducing it, you want to save an emergency fund. So there are different rules of thumbs out there: 3 to 6 months of expenses. There are also other methods I personally use. Just have a base amount per person in the household. So if you're a household of 5, you can say, okay, 10,000 per person, 5,000 per person, whatever that looks like to you. Some people don't like having more than 20,000 because they're like, okay, what emergency is going to pop up that's going to be over 20,000? You understand? So, but the point is, you want to have an emergency fund. The rule of thumb is usually 3 to 6 months of your monthly expenses. So, however much you make in a month, take that, times it by 6, times it by 3, times it by 4 or 5, whatever you want to use. Minimum of 3, maximum of 6, and save that amount. Okay. And this is because if anything happens, you have at least some sort of buffer between you and just life. Okay. The other thing you want to make sure you have is your down payment. Obviously, when you decide to get a mortgage, you're going to have to put something down. Usually it's a minimum of 5%. Okay. And you can also put up to 20%. You can put more down. So you can put 80% if you have it, but you want to save a down payment of at least 5% of what you're looking to buy. The other thing I always tell people is get pre-qualified. Like a lot of times people talk to me, they want to buy a house. I'm like, okay, have you spoken to a bank to even see what they would give you, if they would even give you a mortgage? Excuse me. And 9 out of 10 times the answer is no. So go to the bank, talk to them and say, okay, I'm thinking of buying a house. What would you qualify me for? So get a pre-qualification done. It's free. It doesn't cost you anything. They're going to ask you different questions about your income, about your financial history, about the type of house you want to buy, about how much you have saved, about, your debt and all that. Get those questions answered. Go through the process so at least you know what to expect and see how much they would actually give you. One caveat though, the banks usually pre-qualify, and I say this in every video when I talk about this, they qualify you based on your pre-tax income. And we all know in Canada, you have to pay taxes. So just because they tell you can afford a $600,000 house does not mean you can afford a $600,000 house. What you want to do is to make sure you check that monthly payment to make sure it's no more than anywhere from 25 to 35%. Again, if you're in a market such as Toronto or Vancouver, chances are your numbers are going to be a bit skewed just because of how house prices are in those cities. But you also want to be careful because in those cities you have people that are having mortgage payments as high as 75% of their take-home pay. It's very hard to have a life, you understand, when you have 75% of your take-home pay going towards your house. Okay, so in those cases, one might want to reconsider what their approach is generally to finances. But if you're in the market, you're not yet in that position, again, because some people didn't plan to be in that position. Okay, so no judgment here. If you're in the position that you're just about to buy, try as much as possible for the payment, meaning your mortgage payment every month, to cost no more than 35% of your take-home pay. I personally prefer it to be around 25%, but I know in our current, housing market, it's not impossible, but one has to be strategic. Okay, so it's not impossible. Please do not believe that it is impossible. Take that from your mind. There are people that are living on less than that have housing costs that are 25% or less of their take home pay. Okay, um, and then last but not least, get to know your local real estate markets. So a lot of people that want to buy houses, they've never even gone for an open house before or gone to see a show home. Me and my husband, we're not even looking for a house, but we go every year because I always like to know what's going on in my local real estate market. I check the real estate board at least once a month. You understand? I want to see, okay, an $800,000 house. This one in this area sold for this much. That one in that area is, this is how much they listed it. This is how much they listed it. I may not know how much it's sold for just because usually that's confidential, but you can see how much it was listed. So when you see a $600,000 house, you see a few $600,000 houses, and it puts in your mind, okay, this is how much you can get for 600,000. This is what you can potentially get for 600,000, or this is what you could potentially get for 400,000. This is what you could potentially get for 800, a million, whatever your budget is. Okay, so get to know your real estate market. Go to open houses, go to show homes, meet realtors, ask questions. You understand? There's nothing on your neck. Nobody's gonna stand on your neck for you to buy the house. Just go and check it out, and you get to see what your money could potentially afford you. Okay, as you go through the process. So let's get right back to interest rate cuts. So like I mentioned, I don't see it going any less than 3.5%. They've only reduced it by 0.25. I don't think they will be as aggressive in reducing it as they were in increasing it. So if you remember, when they were increasing it, pretty much every quarter they took it up 0.25, 0.25, 0.25. I don't see that happening in terms of it going down. I feel like they're gonna give, because again, when monetary policy like this happens, so for example, they've reduced it by 0.25 points, it takes at least 18 months for them to even see what the effect of that is going to be. Okay, it takes a while for you to see what the effect of that will be. You understand? So I really think they're going to take their time in how they reduce it. But one thing I do want to mention though, so again, that's what I'm saying, we all need to pay attention to all these economic factors because they should, to a large extent, give you an idea of what you as a household should start doing. Like I mentioned here at Fix It Finance all the time, you are ultimately responsible for your financial health. It's all you, nobody else. Nobody's coming to save you. Nobody's coming to, you understand? When I say nobody's coming to save you, in the sense of you have to take the bull by the horns when it comes to your finances. Like you have to take it head on. Don't be in denial. Don't bury your head in the sand. Face it head on, what it is that's going on in your house. If you're in a lot of debt, that's okay. You can always come out of debt. If you've lost your job, that's okay. You can always find another job. Basically, don't shy away from what your finances are telling you. Okay. Um, the rate cuts, to a large extent, depending on the type of situation you're in, um, overall, it basically means for every dollar that you're putting into your mortgage, now more is going towards principal instead of um interest. I was reading somewhere, I believe, based on the calculation they made, depending on the type of mortgage you have, some people could see as much as $100 in savings, you understand, from this 0.25 cut. Okay. I do want to mention, if you are in this boat, for example, whereby you have a fixed mortgage payment but you're in a variable rate, before renewal season comes, I would highly suggest you go check out, what your story is saying in terms of your mortgage. Okay, let's put a pin in that one. Before we go into that particular issue, let's talk about this. So, as of 2024 Q2, so we're currently in the second quarter of 2024. The big six banks of Canada, they've set aside roughly $4.3 billion, okay, to cover losses that could arise as a result of people defaulting on their mortgages. Okay, this is double what they had last year. As of last year, it was 2 point something billion. As of this quarter, the current quarter we're in, they've increased it again. They even increased it from last quarter to this quarter to $4.3 billion. Okay. And this is basically to cover, okay, the potential losses they could have if people start defaulting on mortgages. Why is this important? As you know, a lot of mortgages are coming up for renewal between, 2024, 2025, and 2026. And that's because in Canada, most mortgages are 3 or 5 year terms. Okay. So if you count from COVID started in 2020 technically, because that's when the first shutdown happened, even though the actual virus was out before then. But the first shutdown happened in March of 2020, I believe. So now a lot of people that renewed their mortgages, or a lot of people that bought homes in those seasons, a lot of them are coming up for renewal 2024, 2025, and 2026. Okay. And the banks are getting ready, just in case a lot of people cannot afford to renew those mortgages. Okay. Or cannot afford to stay in those mortgages. So now, if that's the case, okay, you as an individual, you as a household, what does that tell you? In our video where we talked about credit worthiness, and we talked about the jobs of the bank, the jobs of the bank is to make money. If the bank if the bank is a shoring up, like they are cleaning up house, in the sense of they are getting ready for tsunami, you as an individual, what do you think you should be doing? Genuine question. If the bank that has access to way more data than we do, that they don't necessarily share, that has access to, no offense, the back end of everybody's banking information, because all of us on this call, for example, today are banking with at least one or two of these banks that we're talking about. So they see our transactions going in and out, going in and out. They have AI that can analyze a lot of these things. They see not just our bank accounts, they see the bank account of companies and employers. They see the cash flow going in and out, going in and out. They are doing all this analysis on the back end, and they are preparing for a quote unquote tsunami. As an individual or as a business, what do you think you should be doing? You understand? So, in my opinion, I think if the banks are getting ready for a tsunami, you as an individual should probably start getting ready for a tsunami. So, what does that look like? That basically means, as an individual, you need to start looking at your finances and again, finding ways to free up your cash flow. Okay. So, what the bank is doing is they're putting all this money in reserve, putting all this money aside, getting ready for what could quote unquote happen. If I were you, I would do the same, in the sense of I will clean up shop, clean up house. Okay, where can I cut spending? Where can I increase my income? Where can I, get more efficient in what some of the things I'm trying to do? Okay. Because again, as things begin to move and shift in the economy, you as an individual want to make sure you are in a position. We don't know, a lot of these things are out of our control. Okay, we don't know what is going to happen. For all we know, the money they set aside, they may not even need to use it. But my point is, you as an individual want to put yourself in optimal states to make sure you can take advantage of any opportunities, or at least not be washed away if the tsunami comes. You understand? So I'll leave that there, and then we can shift back into what I was talking about. If you are someone that is in a variable rate mortgage, but you have a fixed mortgage payment. Okay. So just so you don't get sticker shock when you go to renew your policy, you want to make sure that you're looking, at your annual mortgage statement and taking those numbers into consideration. Because if you were in a variable rate mortgage, but your payments were fixed, chances are a good chunk of what you've been paying has only been going to interest. So you've not paid anything, not anything. You've paid very little, or not as much as probably someone who has a fixed mortgage, or even a variable rate mortgage, but the payment changes. But if you're in that boat whereby you have fixed payments, variable rate, you want to go and check with your bank, not necessarily with your bank, you want to check your statements and to see, okay, where are you sitting at from an equity standpoint? Let's say your mortgage is going to renew in 2026. You currently pay $2,000 a month, of which you've looked and you've figured out 1,800 of that, or even 1,500 of that, is going towards interest. You understand? And the rest is going towards principal. So you're not paying enough on the principal. When you go to renew, chances are you're going to have to make a balloon payment. What that means is a lump sum payment in order to be able to afford the home again, or you may not be able to afford that house at current interest rates. Okay, so rather than let the thing catch you by surprise in 2026 or 2025 or even later this year, if you have to renew, now is the time to look at those statements and figure out, okay, where am I sitting? You understand? If you bought a house for 500,000 and you've only paid off 590, you've only paid off 8,000 on it. You understand? And you're going into renewal season. And 8,000 is you've been paying for the past 3 years. If you want to make sure you look at those numbers and figure out what you need to start doing today. Even if that means paying an extra 200, extra 400, extra $100 on that mortgage to make sure when you get to renewal, you're not going to run into issues. Okay. So if you're in that boat, you want to make sure you check that today. Okay. I guess I'll leave that there. If you have more questions about that, feel free to send a DM and whatnot. But I wanted to mention some other statistics that I think I already mentioned this, but as of last I checked, which was this month, actually yesterday, 75% of a lot of people in the larger housing markets like Toronto and Vancouver, survey says a lot of them are using upwards of 75% of their take home pay to pay for housing. Okay. And that is a lot of pressure on your personal finance. So if you're currently there, I pray that, God's mercy and just help would be provided, and as much as possible, you can find ways to decrease your spending and increase your income. I know it's not necessarily easy, but I really hope you're not, I really pray for you that, God will provide a means to alleviate that pressure. The other statistic I wanted to mention, again, this is just another economic factor. When I say house prices are likely not going to go down anytime soon. So as of this year, 66% of Canadians either own a home or are living with someone in which they own the home. You understand? So if house prices drop, you're going to affect 66% of Canadians who see their homes as, for example, a means to retirement, as an investment, who see it as something that can produce for them in the future. You understand? So even if the government wanted to reduce home prices, there are too many factors to consider, such that one, they can't even do that because the economic factors have to play in such a way that the home prices naturally reduce. But I just wanted to share that statistic. 66%, roughly a third, like 2/3 of Canadians either own a home or, are living with someone who the person that they're living with owns the home. Okay. So you definitely want to take that into consideration. So if you are yet to buy a home or if you're currently shopping for a home and whatnot, it is a worthy endeavor. Don't believe the hype. Again, there's no pressure. If you can't afford a home, you just can't. Focus on other things like improving your income earning capacity, finding ways to cut expenses if you still have room. But there's only so much you can cut. You understand? At what point you decide to focus on the other side, which is to increase your income. Okay, or find ways to increase your income earning capacity. Things like going back to school, learning a course, taking a trade, starting a craft business, whatever that looks like. Okay, so nothing wrong with renting and nothing wrong if you're not in that boat. But again, if you are in this picture, if you're in this category, these are just some statistics you want to know and you want to understand, even as we go into further interest rate cuts. Okay, so if you learn nothing else from this video, like I mentioned, some of the things you need to know if you want to buy a house: pay off all high interest debt or significantly reduce it, save an emergency fund, save a down payment, get pre-qualified. And always remember, they're going to qualify you on pre-tax income. So just because they qualify you for 600,000 does not mean you can afford 600,000. What you want to make sure is the mortgage payment is no more than 25 to 35% of your take-home pay. Again, that frees up enough cash flow for you to be able to do other things in life, like eat, pay for your child's extracurriculars and all that. And of course, get to know your local real estate markets. Okay, some statistics to know or some economic factors affecting housing right now. So if you're holding your breath that house prices are going to come down, I don't think so. For different reasons. One, demand is super high. For every house that's on sale, there are 3 people that want to buy it. Okay, and 3 qualified people, not just people that are wishing. 3 people that they have the money, they are ready to go. Okay, roughly 66% of Canadians own homes right now. So meaning a lot of people have their future tied into, when I say future, in the sense of it's an investment, it's something they're looking for retirement. A lot of people, for example, say the boomer generation or the Gen X's, they've been paying off their houses, and now those houses are what they're going to use to eat in their old age. And you think the government is just going to reduce that? Those people will, anyways. There are too many factors involved. Um you know what else? What other factor did I mention? I mentioned quite a few. Um, oh yeah, debt. So, Canada as a person, if you looked at Canada as a person, she has all this debt on this side. So she needs all these assets to continue to go up in value on that side. And then of course, immigration. A lot of people coming into Canada, they're gonna need housing, they're gonna need jobs. So those are just some of the few factors that are affecting demand and supply. I didn't go into some of the things like trades and all those other things that are also affecting demand and supply, but these are just some factors for you to consider. So yeah, we also talked about how interest rates might likely stay around that 3.5%. That's just my humble prediction. um and I don't think they will be as aggressive with taking it down as they were with taking it up, just because um they don't want to what's the word I used earlier, but basically we don't want to see hyper borrowing again, you understand, because it can shift the economy into hyper consumption again, and they don't want that, especially when inflation is still being balanced. Excuse me. Okay, that brings us to the end of today's videos. We will continue our investment series next week. Oh, I had this going throughout. I'm sorry, I didn't realize that. We'll continue our investment series next week. Feel free to join us. And yes, have a wonderful, wonderful rest of your day. Enjoy your weekend. Thank you all for joining today. Have a good weekend. Bye.